Simplified explanation. Context. The Reserve Bank of India, RBI, has announced measures to address the shortage of liquidity, availability of cash in the banking system by conducting variable rate repo (VRR) auctions daily starting January 2025. This decision aims to provide banks with the funds they need to maintain smooth financial operations. Key points. 1. Variable rate repo (VRR). A VRR auction allows banks to borrow money from RBI for a short period, maximum of 14 days, at interest rates determined by market conditions. These auctions help manage liquidity shortages efficiently. 2. Initial VRR auction details. The first daily VRR auction was conducted on January 16, 2025, worth 50,000 crore. Apart from regular banks, standalone primary dealers, financial entities specializing in government securities were allowed to participate. 3. Reason for daily VRR operations. Liquidity in the banking system is currently in deficit, measured at 2.09 lakh crore as of January 14, 2025. RBI's increased intervention in foreign exchange markets, e.g., managing currency value, and a decrease in India's forex reserves, at a 10-month low as of January 3, 2025, are the primary reasons for the liquidity shortage. 4. Other RBI measures. RBI reduced the cash reserve ratio, CRR, for banks in two steps, 25 basis points each, starting December 14th and December 28, 2024, to release more funds into the banking system. R is the percentage of a bank's deposits that must be kept with RBI in cash. Important terms explained. 1. Variable rate repo, VRR, a mechanism where banks borrow from RBI for short periods, up to 14 days, at market-driven interest rates, usually lower than the repo rate. Example, if a bank is short of cash, it can participate in a VRR auction to borrow funds from RBI and repay within the stipulated time. 2. Cash reserve ratio, CRR. The percentage of total deposits that banks must maintain with the RBI is cash. Lowering CRR means banks can use more of their deposits for lending, increasing liquidity. Example, if a bank has 100 crore in deposits and CRR is 4%, it must keep 4 crore with RBI and can use the remaining 96 crore for lending or investments. Potential SBI IBPS-PO exam questions. 1. What is the purpose of conducting variable rate repo VR auctions by RBI? A. To reduce inflation. B. To infuse short-term liquidity into the banking system. C. To control the fiscal deficit. D. To increase foreign exchange reserves. Answer 2. As per RBI's recent decision, what is the maximum duration of loans provided through VRR auctions? A. 7 days. B. 14 days. C. 28 days. D. 90 days. 3. Which of the following is correct about CRR, cash reserve ratio? It is the percentage of a bank's deposits kept with RBI in the form of cash. B. Increasing CRR reduces liquidity in the banking system. C. CRR is decided by the Reserve Bank of India. D. All of the above. Answer D4. As of January 2025, what was the liquidity deficit in the banking system according to RBI data? A. 2.09 lakh crore. B. 1.5 lakh crore. C. 75,000 crore. D. 50,000 crore. A. The RBI's daily VRR auctions and reduced CRR are proactive measures to address the liquidity deficit in India's banking system. Understanding terms like VRR and CRR is crucial, as they are commonly asked in banking exams. Explanation. Context. On January 16, 2025, the Reserve Bank of India, RBI, updated its Foreign Exchange Management Act (FEMA) 1999 regulations to promote the use of the Indian rupee (INR) and local currencies in international trade. This move aims to strengthen the rupee's role in cross-border trade, especially amid its depreciation. Key changes under FEMA. 1. Indian banks can open INR accounts for overseas clients. Indian banks with overseas branches can now open INR accounts for foreign individuals or entities. These accounts can be used for legitimate transactions, e.g., payments, investments, with Indian residents. 2. Non-residents can settle INR-based transactions. Non-residents can use balances in their special non-resident rupee, SNRR, and special rupee Vostro accounts, SRVA, for transactions with other non-residents. These accounts can also be used for investments, such as foreign direct investment (FDI). 3. Flexibility for Indian exporters. Indian exporters can now open accounts in foreign currencies abroad to receive export payments and pay for imports. This simplifies international trade settlements. 4. MOUs with central banks. RBI has signed agreements with the UAE, Indonesia, and the Maldives to encourage trade using local currencies, reducing dependence on foreign currencies like the US dollar. Hack important terms explained. 1. Foreign Exchange Management Act, FEMA, a law introduced in 1999 to manage and regulate foreign exchange and cross-border transactions in India. 2. Special Non-Resident Rupee, SNRR account, a bank account in Indian rupees, INR, that can be opened by individuals' entities residing outside India. Duration cannot exceed 7 years. Example, a foreign company with business in India can hold an SNRR account to settle payments. Note, entities from Pakistan and Bangladesh need prior RBI approval to open such accounts. 3. Special Rupee Vostro account, SRVA, a type of account where a domestic bank holds funds on behalf of a foreign bank in Indian rupees. Launched in July 2022 to facilitate international trade using INR. Example, a foreign bank collaborates with an Indian bank to settle trade payments in INR. Important condition, the foreign bank must not belong to high-risk countries listed by the Financial Action Task Force, FF. 4. Financial Action Task Force, F, a global organization that combats money laundering and terrorism financing. Countries on FATF's high-risk or non-cooperative list are monitored for financial risks. Potential SBI IBP SPO exam questions. 1. What is the purpose of RBI's changes to FEMA regulations in January 2025? A. To promote exports in US dollars. To encourage cross-border trade in INR. C. To reduce forex reserves. D. To stop foreign investments in India. Answer. 2. Which of the following accounts allows non-residents to hold funds in INR for transactions in India? A. NRE account. B. NRO account. C. SNRR account. D. RVA account. Answer C3. Special Rupee Vostro accounts, SRVA, were introduced by RBI in which year? A. 2020-2021, C. 2022, D. 2025. 4. What is the maximum duration for holding an SNR account as per RBI guidelines? A. 3 years, B. 5 years, C. 7 years, D. 10 years. Answer C5. Which organization ensures that correspondent banks under SRVA are not from high-risk countries? A. RBI, FATF, C. CB, D. IMF. Answer summary. RBI's changes to FEMA encourage the use of INR in international trade, benefiting exporters and reducing dependence on foreign currencies. Key concepts like SNRI and SAF-ATF monitoring are crucial for understanding cross-border trade mechanisms. Context. In January 2025, Bank of Baroda launched the BOBI Liquid FD scheme to combine the benefits of fixed deposits FDs with the flexibility of a savings account. It is designed to help customers access funds in emergencies without losing the fixed deposit benefits. Key features of the BOBI Liquid FD scheme. 1. Partial withdrawals allowed. Deposit holders can withdraw a part of their FD without breaking the entire deposit. The remaining amount continues to earn interest at the agreed rate. Flexible deposit terms. Minimum deposit $5,000 in multiples of 1,000. No maximum deposit limit. Tenure 12 to 60 months. 3. Interest rates for general citizens between 4.25% and 7.15%. For senior citizens, higher rates with a maximum of 7.3% for deposits below 3 crores. 4. Premature withdrawal rules. No penalty for FDs up to 5 lakh if withdrawn after 12 months. Penalty for FDs below 1 crore. 1% reduction in applicable or agreed interest rate. Penalty for FDs of 1 crore or more. 1.5% reduction in applicable or agreed interest rate. Important terms explained. 1. Fixed deposit, FD. A savings instrument where a customer deposits a fixed amount for a specific period at a predetermined interest rate. Example, a customer deposits $50,000 for 2 years at 6% interest annually. 2. Partial withdrawal in FD. Withdraw a portion of the FD amount while keeping the rest intact. Example, if you have 1 lakh in an FD, you can withdraw 10,000 in an emergency. The remaining 90,000 continues to earn interest. 3. Premature withdrawal. Withdrawing an FD before its maturity. Penalty example: if an FD of 1 crore is withdrawn early, the interest rate may reduce by 1.5%. Benefits of BOBI Liquid FD: provides liquidity during emergencies without closing the entire FD. Helps balance the benefits of FDs, higher interest, with the flexibility of savings accounts. Encourages savings by offering penalty-free withdrawals for smaller deposits under specific conditions. Potential SBI IBPS PO exam questions. 1. What is the minimum deposit amount required for the BOBI Liquid FD scheme? A. 500, B. 5,000, C. 1,000, D. 10,000. Answer 2. What is the maximum interest rate offered under the BOBI Liquid FD scheme for senior citizens for deposits below 3 crores? A. 7.15%, B. 7.3%, C. 7.50%, D. 7.25%. Answer 3. What penalty is levied on premature withdrawals of FDs of 1 crore or more under the BOB Liquid FD scheme? A. 0.5%, B. 1.5%, D. No penalty. Answer C4. For what duration can a BOBI Liquid FD be opened? A. 6 to 24 months, B. 12 to 60 months, C. 1 to 10 years, 3 to 5 years. Answer. The Bob Liquid FD offers flexibility to customers by allowing partial withdrawals without affecting the remaining FD. It is suitable for individuals seeking higher returns with emergency liquidity options, making it a unique alternative to traditional FDs. Understanding key features, such as penalties and interest rates, is critical for exam preparation. Simplified explanation. Context. According to a report by the PhD Chamber of Commerce and Industry, PHCCI, India is set to become the fourth largest economy by 2026, surpassing Japan. The report highlights India's strong economic growth, projected GDP growth, inflation trends, and strategic measures to sustain its high growth rate. Key findings. 1. India's GDP growth projections. GDP growth in FY25, 2024-25, 6.8%. GDP growth in FY26, 2025-26, 7.7%. India is expected to become a USD 7 trillion economy by 2030 and USD 10 trillion by 2034. 2. Tax reform suggested. The 30% income tax rate should apply to individuals earning above 40 lakh instead of the current threshold of 15 lakh. Tax rates for proprietorships, partnerships, and LLPs CHAS should be reduced from 33% to 25%. 3. Inflation projections. Inflation in FY25 is expected to be 4.5%, and in FY26 it is expected to drop to 4%. Consumer Price Index, CPI, inflation is projected to decline further to 2.5% in the coming quarters. For investment trends, gross fixed capital formation, GFCF, the GFCF is at 33.5% of GDP, indicating strong industrial growth and sustainable capacity expansion. 5. Strategies for sustained growth. Increased capital expenditure, improving the ease of doing business, reducing business costs, promoting labor-intensive manufacturing. 6. Exports goal. India aims to achieve USD 2 trillion in exports by 2030. Hash important terms explained. 1. GDP, gross domestic product, the total monetary value of all goods and services produced in a country within a specific period. Example. India's GDP measures the economic output of its industries, agriculture, services, etc. 2. Inflation. The rate at which prices for goods and services rise over a period. Example. If inflation is 4.5%, goods that cost 100 today may cost 104.50 next year. 3. Gross fixed capital formation, GFCF, measures the value of investments made in infrastructure, machinery, equipment, etc. to boost production capacity. 4. Ease of doing business refers to how simple or complex it is to start and operate a business in a country based on factors like regulations, infrastructure, and taxation. About PhD Chamber of Commerce and Industry, PHDCCI, founded 1905, headquarters New Delhi, India. Hemant Jain, a non-governmental organization promoting industry, trade, and entrepreneurship. Potential SBI IBPS PO exam questions. 1. As per the PHDCCI report, India is expected to become the world's fourth largest economy by which year? 2025, B. 2026, C. 2027, D. 2028. Answer B. What is the projected GDP growth rate of India for FY26 according to the PHDCCI report? 6.8%, B, 7.5%, C, 7.70%. Answer C3. What is the target export value for India by 2030 as per the PHDCCI report? A, USD 1 trillion, B, USD 2 trillion, C, US 3 trillion, USD 4 trillion. 4. What is the expected inflation rate in India for FY25? A, 4%, B, 4.5%, C, 3.5%. Where is the headquarters of PhD Chamber of Commerce and Industry located? A, Mumbai, B, Bengaluru, C, New Delhi, D, Kolkata. Answer. Summary. This report highlights India's journey toward becoming a global economic powerhouse by 2026. Key factors include strong GDP growth, low inflation, and strategic reforms. These projections reinforce India's focus on industrial expansion, exports, and ease of doing business, crucial topics for banking and economic exams. Context. The Federation of Indian Chambers of Commerce and Industry, has released its Economic Outlook Survey for FY25, 2024-25. The survey projects India's GDP growth at 6.4%, a decline compared to 7.0% SEP 2024 estimate, and the 8.2% growth in FY24. The decline reflects global uncertainties and domestic challenges. CPI inflation is projected at 4.8%, aligning with RBI's estimates. Key highlights. 1. GDP growth projections. GDP growth in FY25 is expected to be 6.4%, reflecting moderation due to global and domestic challenges. 2. Sector-wise growth projections. Agriculture and allied activities, growth at 3.6%. Industrial sector, expected to grow by 6.3%. Services sector, projected growth at 7.3%. 3. Inflation projections. CPI inflation for FY25 is expected to be 4.8%, and food inflation is anticipated to decline. 4. Economic growth drivers. Government investments in infrastructure, housing, and logistics will drive growth. Manufacturing, electronics, and pharmaceutical sectors are expected to see significant growth. 5. Challenges to growth. Geopolitical tensions, trade uncertainties, and climate-related disruptions, uneven domestic demand, and high public debt levels. 6. Exports and imports forecast, FY25, exports projected at year 450.5 billion, imports estimated at $729.6 billion. 7 additional factors supporting growth, softening inflation globally, easing monetary policies by advanced economies, recovery in sectors affected by high interest rates, technical terms explained. 1. Consumer Price Index, CPI, measures changes in the price of a basket of consumer goods and services over time. Example, if CPI inflation is 4.8%, it means prices have increased by 4.8% compared to the previous year. 2. Geopolitical uncertainties refers to global risks such as conflicts or political tensions that can affect trade and investments. Example, trade restrictions due to tensions between countries. 3. Public debt, total amount borrowed by the government from various sources to meet its expenses. Example, loans from banks, international organizations, or issuing bonds. 4. Median forecast, a value that separates higher estimates from lower ones, providing a middle ground prediction. Example, in export estimates of USD 400, 450, and 500 billion, the median is USD 450 billion. About founded Tower 1927, headquarters, New Delhi, India. Sadharsha Vardhan Agarwal, a non-governmental organization that promotes trade and economic growth in India. Potential IBPSPO exam questions. 1. What is the GDP growth rate projected for India in FY25 according to the FI Economic Outlook Survey? A, 6.4%, 6.8%, C, 7.3%. Answer. 2. Which sector is expected to grow the fastest in FY25 as per the FICSI report? A. Agriculture, B. Industry, services, D. Manufacturing. Answer 3. What is the projected CPI inflation rate for FY25 according to the FICSI survey? 4.5%, B. 4.8, 5.0%, 4.2%. Answer. What is the estimated export value for India in FY25 as per the FICSI report? A. USD 450.5 billion. B. USD 500 billion, C. USD 729.6 billion, D. USD 650 billion. Answer A5. Where is the headquarters of FICCI located? A. Mumbai, B. New Delhi, D. Kolkata. The FICCI Economic Outlook Survey highlights a moderation in India's economic growth due to global and domestic challenges, with GDP projected at 6.4% for FY25. However, growth is expected to be driven by government led investments, recovery in rural demand, and strong sectoral performance in manufacturing and services. These insights are crucial for understanding India's macroeconomic trends, making it a relevant topic for banking exams.